Hey everybody, welcome back to Accounting 1101. I'm glad you're back and I hope you're doing well. We are jumping into Chapter 9 and looking at an old topic in a new way. We're updating the idea of putting all our transactions into one general journal, and now we're looking at kind of putting them into designated special journals according to what kind of transaction they are. So an old friend, the general journal, coming back kind of in a new form here in Chapter 9. Pretty exciting stuff right there. So up to now, every time we wanted to enter a transaction into the accounting system, we put it in one place. We'd put it into the general journal, as you can see right here from our solid fitting days. And, every time we had to make a transaction, we'd put it right in there. And we just kind of organize it by the day. We'd put our transaction in, the debits and credits, and we'd go on to the next one. And then from there, it would get posted over to the ledger account. So that's the process we're familiar with. And there's nothing wrong with that process. It's not like that doesn't happen in some places. But that process does have a few shortcomings. It's not terribly efficient to do that, especially when you consider the fact that in accounting, most of the transactions we make are repetitive. The same type of transactions over and over and over again, but maybe with different amounts to them. And again, go back to solid fitting and think about that accounting cycle project we did. And I know you probably don't want to think about that and you've flushed it from your memory because it was a bad memory for some of you all. But if you think about that project, a lot of those transactions that we did were the exact same. We'd do a transaction and another week or two later, we'd do that transaction again. And give you some examples from that solid fitting accounting cycle project. Selling to a customer on account. We'd debit account receivable. We'd credit revenue. We did that transaction 4 or 5 different times in that project alone during that month. Or how about when we paid employees? We did that transaction 4 times in solid fitting. Debit wages, expense, and then credit cash. We did that 4 different times. Very repetitive, same transactions over and over and over. Writing them out longhand in the general journal is not exactly a very efficient way of doing things. The other problem is, it's not exactly safe to give every accountant in the organization complete control over the accounting system. If I can get into the accounting system and make any kind of transaction I want to, and I handle money, man, that's a bad situation, just rife for the potential for fraud and embezzlement. And I'll give you an example out of the local rag here a couple of weeks ago. The Wilmington paper, Greene County man sentenced for money laundering, Fairborn resident. He was working at a Honda plant in Marysville, embezzled more than $750,000. Well, how did he do it? Well, it says he skimmed from overages where he overbilled somebody. They got a refund, he was skimming off the top. He arranged for double billing people twice, collecting the second billing, I'm assuming, and then approved false invoices. So this guy had the access to get into the accounting system that generated the bills, and then he had access to the money coming in. And then he could hide it since he had access to both. So if we let everybody have access to everything in the accounting system, that can be a problem. Thankfully, we have a solution that we're learning about in Chapter 9. It's called a special journal. Now, a lot of places, especially places that are big enough to have multiple accountants and a big accounting department, will divide things up by function. So instead of just being an overall bookkeeper, you might just focus on accounts payable, and that's the only job you do. And you see in Wilmington here, a few weeks ago, they had a posting for an accounts payable clerk. The only thing that accountant would do is process accounts payable and enter them into the system. That's it. That's all they would have access to. They also had in Wilmington at R&L Carriers a posting for an AR clerk, an account receivable clerk. All they would be doing is processing payments as they came in. And you can see some of the duties and responsibilities on that job. Processing payments, reconciling payments. So that's all they're going to handle. Not to say that that will be their entire job for the rest of eternity. Usually people that work in these clerk positions, they get more education and they work their way up into a full accounting position where they're doing more of a supervisory role. But it's not uncommon for larger businesses to break things up by accounting function. That way, not every single person has complete control over anything in the accounting system. They're limited in what they can do. Just a way to kind of keep things safe. Another internal control. You can see right there at R&L, they also had an accounts payable clerk. Totally different position. And those are two positions that are pretty common for entry-level accounting. If you get your associate's degree at Southern State in accounting, you'd be qualified for a position like that right out the gate, right after college, you know. And you can see right here, 2 years of accounts receivable experience or equivalent. That equivalent would be your associates in accounting. So kind of a good example of a job that you would be qualified for coming out of Southern State with a 2-year degree. So, to summarize all that, some businesses, especially ones that are larger, they will summarize common transactions together in what we call a special journal. And a special journal is one that is designed to handle only one specific type of transaction. So the general journal we've been doing, every transaction can fit in that. No problem. We just put all the transactions in there. A special journal is one where only one type of transaction is going to go into it. We'll group them together, makes it more efficient. So let me give you some examples. We're going to look at four special journals that we're going to look at. We're going to look at a sales journal in chapter 9, our chapter we got right here. And we're going to look at a purchases journal. And I bet you could probably guess what goes into those journals, you know. We'll talk about that in a second. In chapter 10, we'll look at next week, we'll look at a cash payments journal and a cash receipts journal. So when it's all said and done, we will have covered 4 special journals in our 2 chapters here. So let's jump right into it. First one right here. The sales journal. Only processing one type of transaction. Sales of inventory on account. That's it. That's the only thing that's going to go into it. If we sell inventory on account, it goes into that journal. Okay? If we're collecting money from a sale, if a customer's coming in to pay off what they owe, hey, guess what? We'll talk about in chapter 10, cash receipts. That goes in that journal. So the only thing that goes in sales journal is when we sell inventory to a customer on account. They're going to pay for it later. Okay? If we sell to them for cash, goes in a completely different journal. So on your homework problems, you may have to pick out the transactions that actually go into the journal. I'll give you some that don't go in there. So as we look through here, August 1, sold merchandise on account, goes into the sales journal. August 8, merchandise sold on account. The 14th, merchandise sold on account. Sold merchandise on account on the 19th and the 25th. So every single one of these transactions we're going to put into a sales journal. If we sell inventory on account, I'm going to beat the horse until he's dead here. So what's it look like? What in this magical special journal? Like I said, the whole idea is to make things more efficient. So let's check it out here. Here's our sales journal. And how does it make it more efficient? Well, look. You see this column right here. We know when we sell on account, we'd write out a debit for accounts receivable. We would write out a credit for sales revenue, right? Instead of writing 2 numbers, debit and credit, look here. Debit and credit. It's going in one column. It's the same number for both. We just use one column. So we have the date, the invoice number, customer's name, and the debit and credit, the amount. Transaction takes 1 line, not 2. More efficient. 1 line and 1 column shows us both the account receivable debit and the sales revenue credit. These invoice numbers make it easy to go back into the source documents and see what happened if we need to go back and check anything. And then finally, it also shows us no sales on account are missing. It shows us everything is complete because, look, 4, 5, 6, 7, 8. It goes by numerical order. So if I see a gap in there, I know, oh, maybe something's going wrong. So really good internal control right there. That's it. That's all there is to it. If it's sold, inventory on account, it goes in that journal. And we just list it right like that. Now, as far as posting, we could post these over to account receivable and sales one by one, but normally what people do is they wait until the end of the month. Then they total them up, and then they post them over to the appropriate accounts. 113 would be account receivable. 411 would be sales revenue. That's all there is to it. And then after you posted it, you check it off. Bam, posted. Posted the total. Check them all off. And that's where they got posted to. 113 and 411. Account receivable, 113 would be a debit. Sales revenue would be a credit that we posted over. And then we can see those two accounts. There's 113, account receivable, the general ledger. Sales journal, page number 38. There's my debit. Sales revenue, account number 411. There's my credit. Just posted it over. One number at the end of the month. Your problem in your book and your homework will be almost exactly like that. You may have to go through and find transactions that didn't necessarily belong in that and leave those out. But look, the journal looks the exact same. There's my date, invoice number, customer name, and there's the account receivable sales credit. And we just put the number in right there. All there is to it. Sales journal. Couldn't be easier. What about the purchases journal? I said we'd learn two of these special journals in chapter 9. We had the sales. Now we got purchases. The purchases journal used to record purchases of merchandise inventory made on account. That's it. Not for paying wages, not for when we buy inventory and pay cash. It's only for buying inventory on account, meaning we buy it, we'll pay later. All right. So let's look here. Bought merchandise on account. Purchases journal. Bought merchandise on account. Purchases journal. You got the idea here? Merchandise on account. All these are going to go into the purchases journal. A couple of other things I want to point out here that we get into in chapter 10. I just want to introduce them now so we'll be ready for chapter 10. Look at these right here. You see where it says 210 N30 on a couple of those? Those are credit terms. We are buying on credit. We're buying on account. We'll buy and then we'll pay later. Okay? So those terms are right there. When you see something like 210 N30, those are our payment terms on the credit that we've been given. The 2 is a percent. 2%. There we go. 2%. 2% discount if we pay within 10 days. Okay? So 2% discount if we pay within 10 days. The N30 is net 30, meaning we have to pay all of it within 30 days. It's all due within 30 days. So those numbers could change. It could be 115 N45. It could be 315 N15. Yeah, whatever the case might be. But the first number is always a percentage of the discount. The second number is how many days you have to pay in order to get that discount. Then the final number is overall how many days until it's due in its entirety. Okay? The reason that we have credit terms like that is to encourage people to pay a little bit quicker. The people we bought this inventory from, they can't pay their bills with an IOU. They want cash in their hand. So to encourage us to pay them quicker, they'll give us a little bit of discount if we pay quickly. You can see right here, no discount. It just says terms net 30. That just means we have 30 days to pay and we don't get a discount. The other ones are all 210 and 30, meaning we have 2% discount if we pay within 10 days. So purchases journal, bought merchandise on account. Another note about this journal. Every time we've bought inventory up to now, we've always just debited inventory. Some places actually have what they call a purchases account. And every time they buy inventory, they put it as a debit into a purchases account. And then any other cost along with going along with that inventory, like freight in, where they paid to have it shipped to them, that would be a separate account as well. And there's something called the periodic inventory system. We don't talk about that a lot. We are more focused on what we call the perpetual inventory system, where inventory is kind of updated along with cost of goods sold every time we sell and buy something. But there is another way of kind of accounting for it for really small businesses that don't really have a lot of inventory. So just a note about that if you see that in your problems. Here's our purchases journal. Again, anytime we buy inventory on account, we're going to put it in here. We have our date, we have the vendor we bought it from, the invoice number, and the invoice date. Then we have the payment terms. Again, 210 net 30, 2% discount if paid within 10 days, have to pay within 30. Here's our accounts payable credit. Because all of these transactions involve us buying inventory on account, we'll have a number in that for everyone. Freight in debit is another way of saying shipping expense, where we paid to have it shipped. And then purchases debit is basically the cost of the inventory that we bought. Sometimes you'll see those two together if we have a perpetual inventory system with just one account that says inventory, and that would be a debit. But we're breaking it down because we're doing, in this example, periodic inventory system. We're breaking it down between freight in, shipping cost, and then the cost of what we bought. Okay? So that's it. Purchases journal. Purchasing inventory on account. When we post it, just like we did before, we'll total it up at the end of the month. The total goes to each individual account. There's accounts payable, account 212, freight in or shipping expenses, 514, and then purchases, which is the inventory we paid for, 511. We just post the totals. That's all there is to it. Problem number 6, you have one very similar to what we looked at just right then. You can see that you got the exact same columns right there. The payment terms going on. Supplier's name, you just got to plug the numbers in. Total it up. That's all there is to it. One more thing to talk about. These aren't really special journals per se, but we also in accounting have what we call a subsidiary ledger in some cases. Okay, so we're not talking about journals where we're posting transactions. We're talking about ledgers, remember? Ledgers are individual accounts, so these are subsidiary or subordinate to some individual account. A detailed listing of what is in a general ledger account. We're looking at subsidiary ledgers for account receivable and accounts payable. What those do is it gives us a specific breakdown of what's in those accounts. Who owes what if we're talking about an account receivable, and who we owe if we're talking about an accounts payable. So here's an example of an account receivable ledger. Here's the main ledger account, AR, and here's the subsidiary ledger, every single customer. You see Green River Rafts, that's one customer, 1,116. There's that amount in the AR ledger. High Flying Adventures, balance of $2,226.30. Yeah, it could be a couple of different amounts there. We have Marty's Fly Fishing Adventures, $1,594. You see that amount right there. Mesa River Rafting Company, $1933.50. So those two guys right there would be High Flying Adventures. So the subsidiary ledger for accounts receivable is a breakdown that shows who are the customers that make up the balances in my account receivable balance. And then we can make a schedule out of them. So back to that job posting that I showed you. If you were an account receivable clerk, you would be basically processing payments in these receivable accounts, in these subsidiary ledger accounts for each individual customer, keeping track of who owes the company what, and then maybe making a schedule of all those people and adding them up. You can see the schedule there agrees with the balance in the account receivable ledger account. So that's a subsidiary ledger. ledger that kind of keeps track of all the individual amounts in a ledger account. Easy as that. We'd have the same thing for accounts payable, only it'd be people that we owed for our inventory purchase. Exact same idea. So that's where we're at in Chapter 9. I had another video that walked through some inventory transactions where we bought and sold inventory. I encourage you to check that out. Between the two videos, you should have your Chapter 9 homework nailed down. Chapter 10, we're going to look at the cash disbursement and cash payments journal. And I'll give you, I'll let you guess what transactions go into those if you want to. We'll check that out in Chapter 10. We'll see you back there for that one.